A few weeks back, we told you that Los Angeles was one of the surprise top-performing apartment markets of 2011's third quarter. But what about the Inland Empire next door? Did we finally get some good news there too? Well, no. Welcome to Apartment Market Dynamics from MPF Research. I'm Jay Parsons with your Riverside, San Bernardino update. All across Southern California, the apartment markets there have consistently trailed the pace of recovery for the U.S. apartment market as a whole. And lately, Los Angeles and Orange County have started to break free of that mold, finally starting to produce some good revenue growth, but we are just not yet seeing that happen in the Inland Empire. Let's give you some numbers here, starting with apartment demand and supply. You can see that demand has actually picked up recently, but still not nearly the level seen in LA. And as you can see, demand is still considerably below the level seen in 2010, especially in the first half of that year, although new supply levels are dropping off too, and that is helping occupancy improve, as you can see in this chart. Good improvement over the past couple quarters, occupancy up 1.2 points between March and September. And that brings the overall occupancy rate to 94.7%, which isn't great compared to the norm seen prior to the recession back in 2006, but it is the best reading seen here since 2007. Still, the Inland Empire has the weakest occupancy rate among the Southern California markets, and by a considerable margin. San Diego on top at 96.8%, followed closely by LA and Ventura. Orange County is catching up as well, and that leaves Riverside, San Bernardino well behind. Still, some upward movement in occupancy, so that's good, but it's not yet translating to some meaningful rent growth. Same-store rental rates climbed 1% in 3Q, and they're up just 2.7% year over year. When we look at this chart, you can see there's still a ton of ground to make up since rent cuts were pretty significant here back during the recession, especially in 2009, dropping as much as 7.2% annually. And as you can see, LA and Orange County have started to pull away from the pack in Southern California. Annual rent growth of 4 to 5% in those markets versus the other Southern California markets still in the 2s. Only Ventura, Oxnard area is below the Inland Empire, 2.3% rent growth there. Of course, the problem in the IE traces to the employment market. The Inland Empire has recorded annual job losses in each of the past 17 quarters, and in the past 12 months specifically, it lost more jobs than any other market in the West region, about 6,100 jobs lost. It is the only one of the Southern California markets that has yet to see annual job change shift back in to positive territory, so it's no surprise to see it at the bottom of the list for occupancy and near the bottom for rent growth. Okay, so we've beaten you down a lot of bad news, but we're going to end it with a little bit of good news for you. We're going to show you the top submarket in the Inland Empire as of 3Q. That is the Foothill area. Occupancy there is at 96.1% and same-store rent growth of 3.7% in the year ending September. Both are tops among Inland Empire submarkets. And looking ahead, the Inland Empire simply remains one of the more challenged markets nationally. We should see occupancy continue to creep up a little bit, but it's going to be really difficult for the Inland Empire apartment operators to record meaningful rent growth until this economy starts to turn the corner. And that wraps us up for the Inland Empire, so until next time for Apartment Market Dynamics and MPF Research, I'm Jay Parsons. Thank you for watching.
Want more? Go deeper with MPF Research's apartment market reports. From a national level, down to individual metros, to specific neighborhoods, MPF Research has been providing unparalleled apartment market intelligence to the multifamily industry for almost 5 decades. Learn more by contacting us at 877-284-4938 or visit www.npfresearch.com and click on Market Reports.